Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is the internet's most popular steakhouse a good investment? In this video we will be analyzing if Texas Roadhouse stock is a buy. Could Texas Roadhouse, stock ticker symbol TXRH, be a leading stock over the next few years? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Texas Roadhouse. Texas Roadhouse was founded in 1993, all thanks to the dream that the founder, Kent Taylor, sketched on a simple cocktail napkin. While the name might evoke Texas, Texas Roadhouse is actually headquartered in Louisville, Kentucky, and is famous for their fall-off-the-bone ribs, perfectly cooked steak, made from scratch sides, and legendary margaritas. Today, Texas Roadhouse's popularity has extended far beyond its American roots, boasting over 600 locations across 49 states and internationally in 10 countries. Now let's look at the price action. Starting with the 1-year chart, we see that Texas Roadhouse had a CAGR of about 34%. Zooming out to the 5-year chart, we see that Texas Roadhouse had a CAGR of 19%. Texas Roadhouse share price had been a steady climber but has pulled back recently. This may represent a buying opportunity. If we perform a backtest comparison of investing $10,000 in Texas Roadhouse versus the S&P 500, we find some great results for Texas Roadhouse. In that comparison with the S&P 500, $10,000 invested in Texas Roadhouse would have grown to $28,250 or a 22% CAGR versus $22,796 or a 17% CAGR if invested in the S&P 500. This demonstrates outperformance for Texas Roadhouse. A Texas Roadhouse investment would have been more volatile with a 29% standard deviation versus 18% for the S&P 500. Texas Roadhouse outperformed the S&P 500 in terms of the best year performance, for which Texas Roadhouse grew 40% versus S&P 500 31%, and worst year performance where Texas Roadhouse fell only 4% versus the S&P 500 18% fall. In terms of max drawdown, Texas Roadhouse fell 33%, more than the max drawdown of 24% for the S&P 500. Texas Roadhouse did underperform the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio due to its excess volatility. Now let's hop over to market share and take a look at Texas Roadhouse's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under restaurants and see that Texas Roadhouse is categorized under casual restaurants. Expanding the casual restaurants tab, we can see that Texas Roadhouse has the third largest market share in this sub-industry but is growing. Let's take a closer look at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Texas Roadhouse, TXRH, and see that the market share is 0.49% out of the publicly traded food, beverage, and restaurant stocks currently in the market. Texas Roadhouse is a small company but is growing their market share. The 5-year market share CAGR for Texas Roadhouse is 6.22%. This means that Texas Roadhouse's market share has been quickly growing over time. If we start in 2019, we see that the market share was 0.38%, 0.33% in 2020, 0.41% in 2021, 0.44% in 2022, and rose to 0.49% over the trailing 12 months. This is great market share growth. In this version of market share, we can also compare Texas Roadhouse with other companies or entire industries. A close comparison for Texas Roadhouse is Bloomin' Brands, which owns Outback Steakhouse, Carrabba's Italian Grill, Bonefish Grill, and Fleming's Prime Steakhouse. When we type in the ticker symbol for Bloomin' Brands, we can directly compare the two companies. Texas Roadhouse holds a 49.79% share of the revenue for a basket of those two companies. The really good news is that Texas Roadhouse seems to be taking market share from Bloomin' Brands at a rate of 5.64% per year. This is great news for Texas Roadhouse investors. Let's take a look at the fundamentals to learn more. Gross margin is 16%. This is typical for a casual restaurant company. Revenue has compounded at around 14% over the past 5 years and has reached over $4.63 billion most recently. People love this restaurant. Looking at cash flow, we see a 11% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 13% CAGR. As a result, free cash flow has grown at a 8% CAGR. This is interesting. Texas Roadhouse is clearly investing in expansion while operating cash flow is growing. However, this is causing free cash flow to decline since 2021. At some point we would expect capex to reduce and free cash flow growth to re-accelerate, but it might take some time before that happens. Weighted average shares outstanding have fallen over the last 5 years, going from 70.9 million shares in 2019 to 67.1 million shares most recently. Texas Roadhouse has been busy buying back shares. I love this slow steady decline in shares. Now let's view return on invested capital. Return on invested capital has increased a little from 10.8% in 2019 to 11.6% in 2023. While I would prefer to see more rapid return on invested capital growth, this metric could certainly be worse. And given the massive capex investment, it might be some time before the return on that invested capital is seen. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 6 days in 2019 to 5 days most recently, Texas Roadhouse has gotten a little more efficient over time. I like seeing this trend. Now, let's look at Texas Roadhouse's debt. The net debt to EBITDA has fallen just slightly over the past 5 years, going from 1.4 in 2019 to 1.3 most recently. While a negative net debt to EBITDA value is always better for profitable companies, this debt level is just fine with me. Last, let's explore dividends. Current dividend yield is 1.8% with a dividend payout percentage of 48%. Texas Roadhouse is paying out dividends that its earnings can support. This indicates that the company's dividend practice should be sustainable. Dividends per share for this company have grown at a 17% dividend per share CAGR over the past 5 years and a 16% dividend per share CAGR over the past 10 years. The rate of dividend growth for the company is very good. The fundamentals of Texas Roadhouse are great. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Texas Roadhouse. It is a restaurant company with a gross margin of 16%. The 5-year revenue per share CAGR is 15% and the 5-year free cash flow per share CAGR is 10%. This is great. Strong revenue growth and strong free cash flow growth. I love it. A return on invested capital of 12% is okay, but I would like to see more growth here. Next, the cash conversion cycle of 5 days is not bad and is continuing to improve. Concerning debt, a net debt to EBITDA of 1.3 means that it would take Texas Roadhouse a little over 15 months of earnings to pay back their debt. So from a fundamental standpoint, Texas Roadhouse is again very strong. Now let's switch our attention over to valuation. Texas Roadhouse is slightly overvalued relative to the S&P 500 with a ratio of 1.1. The price to earnings growth, or PEG ratio, is 2.1, indicating that Texas Roadhouse is overvalued relative to their projected earnings growth. Texas Roadhouse has done a tremendous job at focusing on the right things to maximize shareholder value. They are growing market share and free cash flow while investing for future growth by opening new locations. Drilling down into this KPI, we see that the store count is growing about 6% per year but is accelerating. In Q1 2023 they added 7 restaurants, 5 restaurants in Q2 2023, 13 restaurants in Q3 2023, and 19 restaurants in Q4 2023. This means that management is betting heavily that the expansion plans will pay off. While I believe this is a good strategy, investors just need to be careful and make sure that the company does not overspend. Concerning valuation, I actually think the value here is pretty good, but think a pullback may present a more ideal buy point. For me, Texas Roadhouse is going on the watch list. Many thanks for watching. What do you think about Texas Roadhouse, and please be sure to let me know what other companies you want me to analyze. Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.